Bitcoin recently hit a dense resistance wall at $68,000, retreating sharply downward as market momentum stalls. For retail traders, that volatility has immediate consequences. This single downward slide triggered $87 million in market liquidations. While the public focuses on daily price action at the corner of Wall and Broad Street, traditional financial institutions are moving into the space. Massive entities like Fidelity, along with Goldman Sachs and Charles Schwab, are currently lobbying for new digital infrastructure. Traditional power players are currently executing a highly calculated acquisition to secure their place in a new global settlement layer. This shift is driven by the rise of the agentic economy, where artificial intelligence programs operate and execute tasks without human intervention. Traditional banking systems struggle to support these autonomous programs. Slow processing and human gatekeeping create bottlenecks that prevent AI from transacting in real time. Decentralized networks act as native financial rails for these agents, allowing for instantaneous microtransactions that skip the traditional queue. Coinbase is already leaning into this, rolling out AI agents designed to pay businesses directly in USDC stablecoins. To manage this, Sam Altman's WorldCoin project is expanding its human ID network, creating a way to verify human actors within these increasingly automated transaction spaces. Crypto is functioning as the underlying financial engine that makes this autonomous economy possible. This convergence is also physical, moving into the massive server farms that power the crypto ecosystem. To handle market fluctuations and difficulty resets, major Bitcoin miners are finding new ways to utilize their hardware. Industry players like Bitdeer and Ionic are pivoting their computing power away from mining to provide AI cloud services to tech companies. A clear financial tipping point has been reached. In many cases, revenue from AI compute services has crossed the threshold to match or exceed traditional mining rewards. The hardware once reserved for mining is integrating with big tech's demand for processing power, anchoring these facilities in the global economy. For this integration to continue, institutional players require a specific type of protection: legal certainty. This is the primary goal of the Clarity Act, a piece of crypto legislation currently working its way through Washington. Wall Street giants are using their lobbying power to push this bill through a divided Senate. There is a sense of urgency. Supporters believe the bill has a 2-week window to clear the Senate before it gets lost in midterm election politics. These firms are seeking a federal shield, a legal framework that allows them to safely own and operate within the digital asset space. This legislative push represents the final green light for the total institutional absorption of these digital assets. The chaotic, highly speculative atmosphere of early crypto markets is rapidly being replaced by a strict corporate reality. While retail investors track daily price swings, major corporations are busy paving over the blockchain to create a new structural layer. Evidence of this maturity can be seen in Ripple's launch of the RLUSD stablecoin, an institutional-grade asset intended for traditional financial use cases. The passage of the Clarity Act will act as the floodgate that determines when this infrastructure enters the mainstream. The convergence of AI compute, along with corporate stablecoins and federal legal protection, is moving digital assets into the regulated backend of the financial system.